Hey guys, in the previous video we discussed about non-convertible debentures. So now let's take a look at another type of investment opportunity from the same asset class called as MLDs, which basically stands for market linked debentures. These are basically non-convertible debentures, but the returns are not fixed. However, they are linked to a market. Take fixed deposits for example. They provide you with fixed return every month. But in case of MLDs, they provide you the principal along with the interest at the time of maturity. And the return is based on the performance of an underlying index. This underlying index could be anything like equity benchmark like Nifty or Bank Nifty or a government yield or a gold index. One of the major reasons why MLDs are so popular among high net worth individuals are its tax advantage. If you sell an MLD after holding it for 1 year, they attract just 10% of capital gain tax. Not 3 years like other debt mutual funds. Now think about this from a perspective of an investor who falls under 30% tax bracket. Now he only has to pay 10% flat capital gain tax on his profits from MLDs. Another amazing feature is called as principal protected MLDs. To understand this, let's take an example of fixed deposit where you have invested 10 lakh rupees. In case your bank defaults, DIGC will pay you up to 5 lakh rupees only. But in case of a principal protected MLD, you will get your entire amount back. Let's say a company named ABC issues an MLD that pays an interest of 9% per year, maturing in 18 months. But that 9% is only given on a particular condition. If a government bond maturing in 2030 does not fall 25% in price when measured exactly on the 13th month. But this is next to impossible or has a very low probability. If the government bond really has fallen that much, then you get only your principal back without any interest. And the chances of this happening is very rare. So now let's look at some key features that you need to know before investing in MLDs. The minimum amount of investment is 10 lakh rupees and they are generally issued for a tenure of 1 to 5 years. And this is regulated by SEBI, that is Securities and Exchange Board of India, which makes it safer for more investors. And MLDs are usually rated by independent credit agencies. Unlike a bond that pays a fixed return every month or quarterly or annually, MLDs do not pay any regular income. Payment is made at the time of maturity, as we discussed before. Well, now let's also look at some of the risks that are associated with investing in MLDs. Number one, credit risk. So basically, you are lending to a company which could not secure a low interest rate loan from anywhere else. So now they are offering you a high interest rate, which is super tax efficient. This could result in some companies defaulting, but you can avoid this by going through the ratings given by credit rating agencies before investing in them. Number two, liquidity risk. You know how we talked about the tax advantage and principal being protected, but these things do not apply if you exit in the middle. The guarantees only apply if you stay till the end. So now that you have understood the advantages and the risks that are associated with investing in MLDs, let's look at where you can buy these MLDs. These are typically sold by distributors or investment banks who usually get a commission of 1 to 2% of the entry load. MLDs are restricted to a minimum amount of 10 lakh rupees and you can buy this only in the multiples of 10 lakh rupees. And these are issued through an offline process. In the future, you will be able to buy these MLDs from our platform Altius Investech as well. I'm sure now you know how rich people invest in complex way to generate more income. If you learned something new from this video, do like and share this with your friends and follow us for more.